Hello, I'm Laura Furiosi, divorced mother of 3, and I'm here with my mother, Lynette Galvin, with 35 years experience in family law. You're listening to the Divorce Course podcast. Through our candid discussions, we hope to help you through your divorce or de facto separation. We will be answering the most commonly asked questions and covering the stages and steps that you will face on your way to freedom.
The only two certainties in life for our listeners are divorce and taxes. And today we're talking to Pedro Marin from Marin Wealth. We're going to discuss weapons of tax destruction. Welcome, Pedro.
Hey, how you doing?
Good, thank you. And welcome, Mum.
Hello, Laura. Hi, Pedro.
Hey.
Hello, everyone.
Pedro, would you mind telling us a little bit about your background so that our listeners know a bit about you before we get started?
Yeah, so I've been in financial services for well over a decade. I used to be an accountant, shifted towards financial planning. I've been providing financial advice for over 8 years now. And look, I'm currently the managing director at Marin Wealth, and I've helped well over 300 families across my career in just financial planning alone. And yeah, that's obviously my name Pedro means I come from Venezuela, but I came to Australia 16 years ago and haven't looked back.
And you come on our podcast before and done some great episodes, and you've also done a webinar just with us recently on superannuation and divorce, which was a massive success, and we can't thank you enough for sharing your knowledge.
That's right. And we get some lovely feedback from people that you've helped, which is wonderful.
We do.
So good.
We do.
You're a friend of the podcast.
Yes, he is our friend of the podcast.
Yes.
Let's get to the nitty-gritty though. And I know a lot of our listeners are going to go, I'm going to skip this episode because I do not want to know about tax. I don't care. I've got mediation coming up. I'm dealing with a high conflict or a manipulative controlling person, and I'm worried about the kids. Why should they care about tax?
Look, I guess tax is that little gnome that sits in the back of your room, that it's creepy. You don't want to deal with it, but it can be scary if it shows up to your bedroom, like literally. So meaning there is a lot of implications with tax. When people think tax is like a completely separate word, but think about it as debt. If you don't pay your debts, your whole life can be derailed. So your whole credit history can be derailed. The tax office is just another entity that you owe money to. It's just the owning money or the debt component is called tax. So I think it's very important that you understand what your responsibilities are, what your ex-partner's responsibilities were. If you were involved in any structure or legal entity that has your name as a director or somehow responsible for any tax or any debt, because it will impact you after divorce, no matter what. It might impact you forever if depending on the severity of the case. So I think it's very important you understand tax from a whole, array of problems that may occur in the future. You're aware and you can prepare for it.
So, Mum, where have you seen, just for some examples for people who are listening today that are like, nah, it's not going to apply to me. Where are some examples where you've seen this raise its ugly head and surprise people?
Oh, I have to say it's never happened to my client because I'm as nervous as a cat about tax, Pedro. So our clients get told, go and get some independent legal advice. There's a Division 7A. I've seen some cases around that where the debt doesn't always show up straight away when the orders are made, but could come to bite you a year later.
Correct.
So it's kind of, and because lawyers are word people and we're specializing more and more in our areas, we're less, I think, proactive about tax.
But is it because maybe the ex has a business and they don't know what's going on in it, and then there's a tax debt? Is that an example?
Yes, that's one example. Another is with self-managed super funds.
Right.
It's, I think Warren Buffett said it's only when the tide goes out you see who's swimming naked.
Yeah.
And when people separate, especially if one party has had most of the control of the self-managed super fund, then you can suddenly discover that it's non-compliant, that there's money missing, and you signed something 5 years ago that makes you liable.
Agree.
Okay. And then when it comes to the business side, that's the other place where this tax stuff comes up, where if the ex hasn't been paying their GST component or they haven't done 5 tax returns for the last 5 years, does that all come up? And is that included in the divorce property settlement?
You have to deal with it. If it's not dealt with, it either results in unfairness, inequity, or you're going to have to reopen the property settlement to say, hey, we forgot to make allowance for capital gains tax, for instance. So we have mechanisms in the orders that make one person responsible for things, you know, even if it's both of you. But you've got to be careful because the tax department isn't overly interested in your court orders.
Correct.
So, Pedro, can you think of any other instances that people might need to be mindful of where that kind of you owe money to the government thing happens in the super world or anywhere?
Yeah, so even just personal tax. So I think going through a divorce is painful enough and you want to get it over as quick as you can. If your ex-partner is not diligent or it's not order, like it doesn't have its affairs in place, especially with an entity, it could drag for years because you need all your, let's say, your BASs, your tax returns in order for someone just to say, well, just for example, what's the value of the business? You can't value something if you haven't paid your bills, if you're not up to date with the ATO records. So that even just drags it a little bit longer, like if you basically don't know. And I guess the other thing would be even super tax is already complex enough. If someone comes in and said, look, actually, we breached law and we personally are liable for a penalty because it's not the super that it's going to pay for. It's actually you personally who paid the bill. Imagine that coming into the scenario where we had 100 grand in cash. Well, now we don't because we have to pay 20 grand in penalties. And then therefore the pool shortens that also. And you're counting on half of that money to do your life, it can come back and bite you without you understanding that it was coming.
And, you know, as you were talking, Pedro, I remembered another area where people get caught up, and that's in trust.
Yeah.
If they've got beneficiary loans or anything, that has to be dealt with. If there's a debt to the trust or a company, that's forgiven. And you might think that's all there is. There are deeming provisions, aren't there?
Right.
Pedro, for people. So it's quite a risky thing.
Exactly right.
And you need to get the advice.
Yeah, because so to explain it to the listeners, a trust is effectively an invisible person that holds asset on your behalf. So you are, or a company, or you would call that like a bucket company called a corporate trustee, where they effectively are the trustee of that invisible person. So they oversee what's going on in there and they're responsible towards what's going on. So if effectively someone has a trust and there is some debt involved in that trust, complicate things so badly. So I think even before considering, I don't know, this will be my 2 cents for someone, even just before getting divorced, if they know they're going to go down the separation route, probably start getting your affairs in order, maybe get some help, professional help, to to combine all the information and make it clear. So by the time you're about to separate, you're like, look, I know where we stand. I know what's owed. I know because it just makes it much faster, much easier for lawyers to get involved, because if you just put it all on the table, man, this is exactly our financial home. This is what we owe. This is what he owes. And the process is a complete different scenario, because I've seen both cases where one is like, I have absolutely no idea. And the lawyers are like, we have no idea. And it's just very messy, whereas someone comes in, this is my financial home and this is what I want to fight for, or this is how I think it's fair. And then everything streamlined from there.
And before we go into some more what can people do, I just want to clarify for the listeners and us that aren't legal financial people. When you're talking about, so say you do find out that your ex hasn't paid any tax and they've got like a $200,000 tax bill, and you've got a property pool of say $1 million and you're going to divide it up 50-50. Does the tax debt they owe get included in the property pool, or is that your ex's problem?
No, the tax debt that's owed is taken off as a liability. So you will only then be dealing with, what'd you say, $1 million pool?
Yeah.
Take off 200. You really only have 800,000 to deal between yourself, because the debts will be paid off jointly.
Correct.
So the first step when we do property settlement is to quantify the property pool. In other words, what Pedro is saying, what exactly have you got? What exactly are the debts? Mm-hmm. And when someone leaves in circumstances not of their choosing perhaps, or they haven't been able to, it's not safe to get all of that information. The lawyers have ways of doing it, of course, but it can be expensive.
So the issue that I wanted to highlight is if it's their debt, if it's their problem,
It's your
because
debt.
you're married, we're together, it's your debt. So
Yep.
we do get a lot of people writing in, am I responsible for this? Because I had nothing to do with it. It's not my fault. I didn't know. And a lot of people say, I've signed my name on this company or this trust or this superannuation and they've had nothing to do with it. And they ask, can I just tell the tax department I didn't know? Or can I tell the tax department that I had nothing to do with it? Can they, Pedro? Do you have that ever happen?
Yes, but you can't. Look, basically, you are. It's what Lynn was saying. So, again, what I mentioned at the beginning of the conversation was, imagine this debt that you have no idea what the value is. That's how tax works, because you don't know the profitability of a company until you do its entire books, so its entire profit of the period, and then you understand how much debt is there. Sometimes people just forget about it, and you actually pay it the year after. So it could be a debt that was actually a year ago. You have no idea because the accountants haven't done the financials. You technically, so when you finish a financial year, you technically have until May the next year to actually prepare the financials. Even if you don't, yeah, there are penalties, but no one's putting a gun to someone's head, and the ATO is not going to come immediately after you. So you can actually pass that May deadline and still don't know what the debt is until probably, you're about to get divorced. So I think also, and what I've seen with some couples is, if you're a business owner, you're probably already very stressed, probably stretched. And if you add the stress of a divorce, some people just give up. Some people's like, I don't care about my business anymore. And therefore, when you're about to split, you're like, okay, well, we actually need to do the tax return of this thing. And you're under the false impression that all the assets are X. But like Lynn said, well, X minus that debt that is coming, which you had no idea. So I think it's like I mentioned before, if you are somehow thinking of splitting, probably a good idea to start collecting information around the if you are involved in the business. That's another thing. If you're not a director of that business, it's much harder to contact an accountant, ask for information, because ideally you want to have the whole structure just painted, just a whole picture, because you kind of know. Because another thing that it could happen is not even just from someone giving up. Probably you can, I'm not going to say people do it, but it can be done. You can engineer how your tax bill, it can be on a year. So based on like planning, like you can plan like, well, this year I want to pay a lot of tax. So it can be done. Like you can actually, because you effectively say, well, I had an expense coming this year, say a capital expense, and we need, say, a machine. And you're like, you know what, I'm going to defer that one financial year. It could be one financial year, meaning 1 month. Because you can be in June and wait 1 month, and then therefore that year is basically, or the opposite, you bring it forward 1 year. It's like there are ways to not extreme, but there are ways to manipulate the system.
And boy, do we see those manipulations, and it's very hard. You've got to look a long way back. On your point, Laura, in case our listeners are getting a little bit depressed about this, sometimes the tax debts are engineered or left over and then brought into play after separation. And a typical example is where someone hasn't put tax returns in for 6 years. You separate, they put in 6 years worth of tax returns and suddenly bring up all of this debt. Now, actually, that is a debt. You just didn't pay it as time goes by. But if you've been separated, if you separate and the tax is all up to date, and then they don't pay the tax for going forward and you're not getting a benefit from that business, the court will add that back in, or they might say it's not a joint liability.
Right.
So it's kind of a post-separation negative contribution.
So if you're listening and your ex was up to date until you separated and then it's gone south, then you're probably in a better position.
You are.
Now, Pedro, there are so many stories of people who are members of, like I've said before, a tax structure or some sort of company, and they've got no idea because they've trusted their partner. Their partner's taken over all the financials and they've just signed papers as they've come across their desk. How can people find out, what kind of companies and tax structures they might be involved in?
Yeah, there's
if they can't get it from their filing cabinet at home.
There's a couple of ways. Obviously, your ATO portal is one, but the best one could be, there's a thing called Equifax, which is a credit port check. I think it's $14 or $15 a month. That will tell you basically if you're a director of a company. it would actually, within there, it tells you are, because it's your credit file, and being a director is effectively attached to that. There are two, obviously, your personal credit file, and then there's your director credit file. So there's actually two separate things. But it kind of tells you whether your directorship has changed, your address in your directorship has changed, and that would probably tell you a little bit. I guess also an accountant, as if you start with a new accountant, there you basically sign, hey, yes, accountant X, I'm your new client. Please find anything that I have because it's all related to a tax file number. When you start a directorship or when you sign something, the tax file number will basically, it's your, in the US, they call it a social security number. That's basically our same thing here, a tax file number. So either an accountant, Equifax, or the ATO portal will allow you to know where are you, or where's your name attached to any entities.
And lawyers have another way as well.
Yeah.
And that is looking up the records on the ASIC website.
Right.
We have a thing in Queensland, I think it goes nationally, called Cytec Confirm, and you can plug in someone's name and out comes all of their entities and their ownership. We also do, then you can drill down and search that company.
Perfect.
And see who else is in it.
So for people who are listening overseas, I have been made aware that you're not allowed to be photocopying or getting information about anybody other than yourself in some countries. But in Australia, you can.
Yeah.
So these Aussies listening, they could use that system to look up and see what their ex has entangled themselves in.
Commercially, right, the world needs to know who they're dealing with, who's behind these companies. So you can do that search. You can search bankruptcy records. Again, it's a public record.
Mm-hmm.
So, but we are only talking about Queensland. Years ago, you could put in a registration number of a car and find out who owned that car. They stopped that probably for the same reasons as overseas, for privacy reasons. But if you are a company, you're a director of a company or a shareholder of a private company, then that record is up for grabs, and there's no crime with that, no shame in that.
So when it comes to say one of our listeners out right now has discovered this massive tax debt, and can they go to the ATO and say, can we just pay it in installments instead of a whole big whackadoodah? Because then they might not be able to buy a house or something.
You can ask for a payment plan. Obviously, it's not personally, it's for the company. So the company pays it in installments. The problem there is what happens if the company basically goes bankrupt or you are still attached to that. So yes, you can. The idea would probably be maybe to clear that debt as fast as you can, to remove yourself from any further harm, or not further harm, but just risk of something not being paid. So if you can, probably that's a good idea, just to get rid of it and probably clean slate. But if you don't have the cash, which some people do, you can either, there's two options. You can actually do, payment plans with the ATO, or actually borrow money from a bank to pay that. And then so the company can actually borrow against the company's assets and then pay that, which I see that it's very common. Companies, which I don't know why, like, why can you not just plan for taxes beyond my mind? But it's usually come in like, oh, we have X amount of $1,000 we owe. Well, let's just borrow and pay it off. And I'm like, okay, sure.
Mum, do you see ever, like, when it comes to this kind of tax debt issue, how do they, like, does the judge ever get mad if someone has deliberately, as a strategy, not paid tax for a couple of years leading up to knowing they're going to be separated, and then boom, dropping this big debt? Is there any penalties? Does the family court care, or are they like, that's your problem? Or do they see them as go, that's a nasty trick, you're a nasty person, I'm going to penalise you some way?
Yes, well, there's no penalty for being nasty in the Family Law Act, unfortunately. But
there should be. There should be, Mum.
But I tell you what, they get really cranky if you end up in court and there's a tax debt that hasn't been dealt with. And sometimes people have very modest property pools. If they spend, like you were saying, Pedro, they get the money in, they spend it, so they're not actually accumulating wealth, they don't have money in the bank, then the court may, because it's a Commonwealth entity in Australia and the tax department's a Commonwealth entity, they are very close friends in that regard. And so the court will usually just stop the case until the tax stuff's sorted out and dob you into the tax department or refer the case to the tax department. Yeah. There are sometimes tax officers sitting in the back of the big money cases listening to the sworn evidence, and they have some access to the subpoenaed files.
Wow.
Yeah, and that's what I mentioned before. Is like it can be dragged for years. Because you can still try and, go back and forth with the ATO, but they can't enforce. They can enforce a lot of, like, you need to pay this and that. But if there's no money to enforce, you just go bankrupt. Most people just go, well, not most people, but if that's an option, people just go, well, I'm bankrupt. I prefer to, do this for life and not pay you. I don't know. Some people do it out of spite. It's like financial suicide, basically.
Yes.
So I guess that gets me to that next bit. What can people do who are listening today? They've got some sort of massive tax debt. What can they do if they're in that pickle? Is there anything they can do to negotiate, or in the property settlement? Is there something they can put in? If you're separated or about to be and you need to get everything finalised and sorted, but you don't know what to do next, or you're looking for a way to do your own divorce and settlement without spending thousands of dollars on lawyer, then you already know what you need to do, and that is to sign up and become a member of the DIY Divorce Blueprint. Empower, educate and equip yourself with the legal know-how and the tools you need to get divorced or de facto separated and finally settle. Work through this course at your own pace without feeling confused, lost, scared or overwhelmed of all the family law legal jargon and processes. Let us walk with you through this journey and show you a better way. What can they do if they're in that pickle? Is there anything they can do to negotiate, or in the property settlement? Is there something they can put in?
There are a couple of options. Obviously, to anyone who's listening to this, you really want to get out of any responsibility on a legal entity as fast as you can, because you cannot control what the other party is doing. So some of the options are: imagine you're negotiating a house, and then there's super the stuff. If the house, for example, is debt free, you can borrow against the house, give that money to the entity, and then basically you're saying, that's my half of the tax bill. Remove me from the directorship of that company, and then we call it even, and you continue with the home and repaying that debt as you go. So that way you are excluded from any further responsibilities or penalties that can come after that, because your name is still there. The biggest and the most important piece is remove yourself as a director of that company. So any further harm, it's not tainting your name or your credit history. So that's one option. Obviously, not everyone has that option, whether they can borrow against an asset to just include that money into the company and then the company pays, but that's their share, it's basically, if you're, imagine half and half, if your share of the tax bill is $50,000, well, off you go, that's it. And then once the company's paid or whatever it is, the company then pays you back whatever share of the value is given to you. That's one option. The other option is you probably just get an accountant to value the company as it stands, and you go, well, how much is it? Well, if the company is worth $200,000 and your share is 100, and there's $100,000 or say $200,000 in a tax debt, you kind of call it even. So you're like, well, my debt equals the value that I would get out of the you can actually negotiate, like, and that, I would tell you what your partner wants from this. They want to keep the company, but there's a massive tax bill, and the value equates, or your value equates to that tax bill. You can remove yourself by just calling it even. Like, it's just as fast as you can, just remove yourself from those things, so there's no further harm to your name.
Before anybody keeps talking, just it's general education only. So please go and get financial advice or legal advice from an independent legal person, just because every situation is different. There might be some implication for that. So, but that's just a general education. That's what Pedro would do if he was in that situation.
Correct. These are case scenarios that have happened where I've been sitting in front of lawyers and the two parties, or the party that I'm representing, and we're just as a combined in that particular case was where what can we do to just get out of this as quick as we can? And then we get an accountant involved, so they value the whole company inclusive of the debt, and then we can go in and negotiate. Well, the lawyers go in and negotiate that aspect. So it's not. Yeah, you're right. It's definitely factual. It was a case scenario.
So this comes up all the time in my practice, and my instinct is normally to advise clients to get the heck out of there before it goes wrong, and then you've got sort of a line after which it's not, you haven't done anything wrong.
Right.
And the reason many clients won't do that is that they want to be able to keep an eye on how the company's going right up until settlement. And particularly if they're the ones that were doing the books and so forth, they want to remain in there. But yes, my instinct is already always to cut and run.
Yeah.
With that. Another aspect of it, I guess, is that drafting those clauses in law. So I think whenever there's a problem, we can draft a clause to get out of it mostly. And that liability clause or off liability clause has been refined and refined and refined. And so now it's usually something like that the husband will indemnify the wife in relation to the company XYZ, the trust, and for any liability that she has incurred or she may incur in the future as a result of her connection with that business. But Division 7A, which is a deeming provision, we need to look at that because that's where a tax debt can still come up and bite you in the bottom. And the tax department doesn't care if you've reached agreement with your ex.
Okay. Can I just go back a little bit because we're not financial planners or lawyers. What does indemnify mean?
Protect you, pay for, look after you, never get you blamed.
So there's usually a clause you're saying in a lot of separation property settlements saying a clause that you just said, but basically it means that the ex will make sure that the other person is not liable or isn't responsible for any silly business or any suing or any tax or anything.
Yep.
But you're saying the tax office doesn't care about that.
That's right. Neither do the banks normally if you've got a court order. But do you know, the only time I use those clauses is when the debt is paid. Otherwise, we don't enter into an agreement. We get that paid first. Then I have that clause in there just to cover them in case anything else crops up years down the track.
Yeah.
Okay. All right. So Pedro, one of the ways you said to protect yourself was to get yourself off it, to remove your name.
Right.
Do you need your ex's approval to remove your name from these entities, or can you go somewhere and do it and say, I quit my job from this directorship?
You can remove yourself without the other parties, but then it's like a Band-Aid, really. Like it won't fix the problem. You can resign as a director without the other director's permission. So basically just remove yourself as a director, but you're probably still a shareholder of it. So there's the two components of the company. So you own the shares in a company and you're also a director of the company. That's two different things. Share means you are you will take in the benefit if there's profit. So that's effectively how directors, you are liable or you are responsible for that company's activities and dealings and debts. So if the company has no assets and there's a massive debt and creditors come in, you as a director, then your personal assets are coming to play. Basically, your home then gets sold to pay for the company's dealings. So that's why directors is when you are a director of a company, it's massive responsibility. Whereas if you're, and obviously the company cannot do anything without the director's signatures. If there's more, it's like tax returns, dealings with it. It's a very important position, but it's also a lot of responsibility. As a shareholder, you basically it's just like buying a share in stock market. It's very similar. Your responsibilities are very small.
So, Mum, you said write a letter saying I resign.
Yep.
And then to get yourself off as shareholder, you need to
get paid, or you basically withdraw. You default on but it has to be written that you default on the value that you're not getting. So basically, a share will be worth X. So when you essentially establish companies, the share is usually worth like $10 or $1. So they're worth peanuts. But when you actually say you're trading for several years, now that company is worth different because when you come in. So when I mentioned around an accountant valuing a company, it's very important because every industry is different. Like there's, for example, some industries are valued at 6 times their revenue. So that's in the future. So that's quite like, so there are others that's only 1 time. So you have to understand what's the value of this thing based on future income brought today. So then those shares are not worth $10, they're worth X amount. So minus all its liabilities, etc. So if you basically just want to completely remove yourself from shareholders from the whole lot, you are at some point either forgiving that, you're effectively saying, I'm forgiving, or I'm just withdrawing I don't want that money. I just want my name completely removed.
We do that a lot in property settlement. Being a shareholder is, as you say, it's just like having a share in Woolies or something. They never come after you for the debt. So it's all benefit. So really, there's not a lot of harm in holding on to generally as a shareholder until the end. But then the orders will say, usually, if the other person's going to have the company, that you transfer your share to them, and you'll do it normally for value. So if the company came in at 700,000 and you thought of 50% of that, you've got 350,000. If your ex wants the company and all the shares, then you get $350,000 extra of the other company or other property. Sorry, not company.
Yeah.
So you understand, like it's a kind of it's kind of a swap.
And the other thing I will have to point out, like also if you're a shareholder and your ex-partner dies in the process, obviously not going to happen, but if it happens, you're still holding that value because it's in your name. So if the company has a value, then gets sold onto market, and then basically you receive the net proceeds of that, whether your ex-partner is alive or dead.
Oh, okay.
Okay.
That's interesting.
Really probably stupid question, but I'm just asking this because I know I think everybody who's not a lawyer and a financial planner would want to know when it comes to this. So you have your property settlement and they've sold a business or a company or whatever, and they've given you your percentage. Like, let's just use really rounded numbers. Say you got $1 million in the property settlement, and that money is paid into your bank account. And you look at your bank account and you go, oh, I got $1 million, yay. And yay, my property settlement's finalized. Do you pay tax on that?
Depends on which property. So if the property is your principal place of residence where you live, no, that's all yours. If it's an investment property, yes, depending on if there's a gain on the value. So if you bought that home at $500,000 a few years ago, and now it's worth $1 million, there are capital gains tax involved. It gets complicated, but depending on what type of property we would talk about. Oh, it's a commercial property. If it's in your self-managed super fund, all of those pay tax except where you lived. If you lived in that home, there's no tax involved.
So if you are the one who gets the money from the sale of the house and you get $1 million, Mum, how do you make sure you're not the one that's paying the tax on it?
So we've been doing this for years.
Yes.
So if you're selling a property as part of a property settlement, that is an investment property. And if you own it, let's say you own it jointly, it will have usually capital gains tax on it. There are provisions for if it's sold, the capital gains tax gets either paid immediately or an amount roughly equivalent to what we think will be the tax on that is put aside in trust to pay on behalf of the parties later. But
so it's shared.
Yep, it's shared.
Okay.
But if you get that property, that investment property, if you say, look, do you know what? I want that as part of my property settlement, and it comes to you.
And you don't sell it. You
don't sell it.
Yeah.
You inherit the capital gains tax debt on that going forward.
Is there anything you can do about that, or
never sell it?
Yeah.
So basically what you're saying is that you're taking on a property in the agreement. You're saying you keep the family home, I'll take the investment property, and you're not selling it. You need to remember down the track, you're the one who's going to pay tax.
So the way we look at it is that there's court case after court case on this. So the court generally won't look at capital gains tax if there's no current plans to sell the house. Like they're not looking at, so they don't take it off the value of your house. So if you've got a $400,000 house and there's $80,000 capital gains tax, you're really taking $400 worth of house,
right,
unless you're planning on selling it in the very near future. Rosata's case, if that's the case, the court will let you take the capital gains tax off that property. It's quite complex.
Yeah.
And the reason they do it, Pedro, is, and listeners, is that if you don't plan on selling that investment property, then you don't have to pay the capital gains tax right away. And if you sell it 6 years down the track, and the way property prices have been going lately, it might have doubled in that time, or, then you get the benefit of that increase, but you also have to where the capital gains, it rolls over, doesn't it, Pedro?
Yeah, so
the status of the couple rolls over to the person who takes it.
Correct. You take the original cost base of when you bought the home, and it doesn't matter which person owns it. It's just basically it keeps going all the way until sale, and then there are ways to mitigate this. Obviously, attaining financial advice can definitely help you. There are a lot of strategies to try and reduce capital gains tax. There are ways, obviously, living in a high, like imagine you say, I want to now live in that investment property. And effectively from day one where you live, that portion onwards, so you get I tell clients, man, get a valuation on the day you move, because you're only paying tax from the point you bought it to the point you moved in, and after that, there's no tax. So if you bought it out of $1 million, 500, then it's 1 million when you move. You're only liable for the 500 component, and then from that point onwards, there's no tax. Or there's a whole bunch of ways we can try and mitigate to just make sure that when you're planning splitting assets, I'm telling you all the facts. Like, this is the net amount if you were to dispose that property today, whereas if you keep the principal place of residence is this. So obviously the biggest attraction is where you lived. So everyone's just an easier asset, but it just depends on what people really, really want.
Okay, so what about shares then? Say you take the shares, you don't take the house, and you go off, you split it. He gets the house, you get the shares, and you want to turn those shares into cash. Is there tax you have to pay on that?
Same. It's
the same.
Identical. So
you can't live in shares though.
Correct. It's
you can't live in shares.
The two things on assets. So property is a highly illiquid asset. It can take, right now, obviously, it doesn't take too long to sell a property, but say 6 years ago, it would have taken 3 months to just get that, or maybe more, because you then get settlement, and settlement could be another 90 days. So it could be 6 months before you can actually get any cash from it, whereas shares is 2-3 days of trading, and you get the cash immediately. That's the first thing. So liquidity on those assets, and tax is identical. Shares is a bit more complicated because sometimes shares give you a dividend, and that dividend actually buys more shares, and then that's a different. It kind of gets a little bit messy. So you definitely need someone to tell you how would that work. But shares is much more liquid than you. And also, most likely shares move with what's going on in the environment much faster than a property. A property takes a little bit longer. It can go down as well, but it takes longer than shares.
Yeah. So you've got to figure out how long you've had the shares for and get someone to calculate what potentially the tax debt would be if you sold all the shares, and make sure you consider that in your property settlement.
Right. Yes, although again, as Rosada says, that case says, if you don't have current plans to sell them, they won't take into account capital gains tax. The court won't. They won't say, oh, well, there are your shares. You've got $100,000 worth of shares. There's $20,000 of capital gains tax. They don't say, oh, that way you're only getting 80,000 value. They're going, are you selling them? No, I think I'll hold on to them. Well, they're $100,000.
So listeners should keep in their head, if they're getting $100,000 worth of shares, but there's $20,000 worth of tax, they're technically getting 80.
That's right.
So try and keep that in your head. And lastly, cash. What if they just get paid cash? There was property, there was shares, and they just went, I just want the cash part of, do you have, and it wasn't from a sale of a house, it wasn't from sale of shares, it was just money in the bank, and you get that put into your bank account. Do you owe tax on that in your tax return or anything like that?
That's a big fat zero. Yeah, it's just interest. So that's
only on the interest.
The classic cash is king. In a divorce, cash is king as well. It's the easiest asset and instrument to just move around. There's less risk. There's highly liquid. It's just, cash. And at all times, if I'm representing someone, I go straight after the cash because I know the value will be the same tomorrow, the day after that. Yes, it might buy you less goods and services over a year, but it's still the exact same amount, and we can plan with that. So for me, it gives me a lot of, ease, because I will know with what we're dealing. Whereas if you give me shares, I'll go, well, I don't know if tomorrow that might go down by half, and then the whole thing we plan is halved. So cash is king. And I think the other thing, just before you move on, the previous aspect we were talking about, remember this report. It's called an unrealized capital gains report. Unrealized means that whatever you're trading your shares, an unrealized capital gains report, it tells you if you were to sell all the shares today, it tells you how much capital gains would be. So it's called unrealized because it moves. Because imagine your share is worth $100, you bought it at 50. Today, the unrealized is 50 because you haven't sold it. Or tomorrow, that could be, $10 less, so you have 40 unrealized capital. So unrealized capital gains is a great report to pick. Some people have no idea what's named. It's unrealized capital gains. You can always go to whatever your platform is, or anyone to try and help you. That's a report you really want to grab.
Oh, and can you get that online? Like if you're investing through one of the like ComSec or something like that. Okay.
Yeah, it's a very common report.
That's brilliant.
So getting an unrealized capital gains report before you go into a mediation sounds like a really good idea.
It does.
Yeah.
I've learned something. Yeah, really.
Yeah.
And Equifax, which you mentioned before as well, Pedro, is a good way to see where your name is, what your credit rating is, and if you're in any businesses or trusts or anything like that.
Actually, even more than that, it protects you from anyone opening a bank account or a credit card or anything that gets open in your name. So if someone opens a bank account actually not a bank account, it's mostly credit, but if someone opens a credit card on your name, that pings you. It tells you there has been a credit that someone has accessed your credit file, and it say, I don't know, a bank X, and then they're just inquiring on a commercial loan or a personal loan, whatever it is, and that way you can protect yourself further.
And lastly, because I know we've got to wrap up, if these people listening today, that with one of our lovely listeners, they've been dragged through the financial technical mud and they've got a really bad credit rating. Like they're coming out of this, they've got their money, they want to get a house, but their credit rating is mud because, their ex has been horrible with all of this sort of stuff. Is there a way for them to fix their credit rating and get to a position eventually where they can loan for a house, etc.?
100% yes. There is one that probably is near impossible if you are bankrupt. Unfortunately, that's for life. Yeah, for the first 5 years, no one will lend you. Well, not no one, but almost nobody. After the 5 years of bankruptcy, yes, the things are get a little bit better, but that is a stain for your entire financial life. If there was not bankruptcy, so if it was just, you forgot to pay or there was delays and things that would drop your credit score, 1,000% you can increase that by doing things. So there's a variety of things you can do over time to increase your credit score back to where you want.
Oh, that's good. So that's a bit hopeful.
And where would they get that information on how to do that?
Well, talk to myself or talk to even your Equifax, even though it seems like I worked it, but I don't. But it's such a great report. They actually, on your credit report, it tells you a pointers up and down of why your credit report has moved. So, for example, you could be a director of a company for a long time that it builds your credit score because it seems that you're very responsible because you're dealing with a company. So that actually has an up arrow. Your closing credit cards actually goes up. You have a long credit history that arrows up, but then arrows down, you started to inquire too many times about debt. So if opening credit cards, you're opening personal loans, that actually decreases your credit score. There's a few things, and obviously it actually tells you under your score why do you have it, and then you can kind of say, well, if over time if I continue to be a director of this company, it will help me, or if I start closing some credit cards, it will help me. If I don't inquire about credit, that will help me.
That'll help. Yeah, that's good. That's good.
Okay, all right. So I know this was a pretty boring, no offense, Pedro, Mum, episode, but it is if you are a head in the sand, avoidant type person who just does not want to do anything, and when you're going through divorce, the last thing you want to be doing is thinking about this because you're emotional and all of that. But, even if you could just keep in the back of your head to ask your lawyer or ask your financial planner or talk to the accountant about those unrealized capital gains, thinking about, are you on any businesses that you're not aware of? Are there any tax debts that are looming? These are things you need to think about, and not just think about percentage. What percentage am I going to get? And not just think about the house, because this stuff does come around and bite people in the bottom.
It does. If they're aware of it, and if the court is aware of it, the court can make provisions for it. But if they're aware of it and don't know how much, for instance, and they're guessing, they can guess wrong.
Mm-hmm.
So yes, you do. I kind of call it a long tail. What you want is that when you make final property orders, they are final property orders.
So you can't go back and say, oh, by the way, I just found out there's this debt.
Sometimes you can, but hardly ever.
Okay.
So that's an application to reopen a property settlement, and the court is really reluctant to do that. And the ones I've heard recently listening to cases, they've proven that the parties actually did know about that debt. They just swept it under the carpet or didn't tell the court.
Yeah. And I think for the listeners, if you can afford financial advice, definitely it's worth not just the money back to you, but it's worth tears, it's worth hassle, it's worth time. Because we would just pick stuff that probably lawyers wouldn't think of. So obviously we're just dealing with aspects that we just deal every day, not on the divorce component, but like just a regular component. I would go ask these questions. Financial advice is definitely, if you can afford it, sometimes obviously because there's not many of us, it's very expensive right now. But if you can afford it, it is definitely warranted.
Well, thank you, Pedro.
Pedro, if they're putting in a tax return and they do pay to see a financial advisor, is that tax deductible?
Yes and no. I am fighting. Well, we as of my organization, the FAAA, we are all trying to get, because there's two ways of how our fees are deductible, which is absolutely blows my mind. That's what we're trying to get the ATO to just put a standardized, any cent we get paid is deductible. But right now, if you pay a lump sum initially, so example, we do an initial strategy in, like, I sit with you, this is the plan, and it's just the first lump sum, that's not deductible, which is, again, I'm not going to say the word stupid, but it is very stupid. But if you're in an ongoing agreement with a financial planner, and effectively you are paying every month like a retainer, that's deductible. And also the way in which is deductible is the way in the law works is if I am helping you attain an income. So if my advice to you is in any way, shape, or form helping you with your tax, actually the invoice has to say tax affairs. I help you with your tax affairs, and there's some sort of income derived activity that basically like we're putting money X, Y, Z. That is deductible. So it's very tricky sometimes. So it comes down to the invoice of the planner and how the accountant sees it, because if the ATO comes in, it'll go, well, this not matched what the tax law says, but it's just absolutely bonkers why a lump sum and an ongoing. Don't get me started, because I can be here for hours complaining about it. But that's in essence how you can get some of the fees paid to a financial planner deductible. So I guess it gets some tax back.
Awesome. All right. Well, hopefully our members will get some good use out of that, and our listeners as well. Thank you, Pedro, again, for always giving us some great tips. If anybody wants to work with you, where can they find you?
Just go to the website, so marinwealth.com.au, or just on our Instagram, Marin Wealth. There's definitely easy ways to book in a meeting with myself. It's just basically you do get access when you do book online. You get access to my calendar, and because it gets really packed at least a month and a half. So usually just go in, find the best time. It could be online, in person, or via the phone. And usually it's just a 30-minute or an hour conversation just to understand if I can help you, or if I tell you, look, we're not a match, or it's just to try and attain how I best can suit your needs. What are your needs? And if we can work together.
Awesome. All right. And Mum, everybody knows how they can work with you. They can listen to the podcast. They can listen to the podcast. Yeah. All right. Thank you again so much, Pedro, for your time. And thank you again for Mum for everything. Any quick last wise words, Pedro, for anybody about tax?
I think it's just be proactive. Don't bury your head in the sand. I know it's painful. I know if you can smell blood in the water, meaning your relationship is over, be proactive. and contact your accountants, just piece everything, any information you can get that you imagine you're going to work with me. I'm going to ask you all that. And if you tell me I don't know, then it's going to delay the ways in which I can help you. So not just me, just a lawyer will need that. So just get proactive. Picking for information is also king. Having information to piece your life together, your financial home together, will save you money in the future.
And you can go to www.thedivorcecourse.com.au and you can go to our free resources tab and you can download the Before You Go checklist, and that'll have a list of all the kind of stuff that Pedro is probably going to ask you for.
If you can do it safely.
If you can do it safely, go and get that free checklist and be proactive if that's you right now. All right. Thank you, Pedro. Thank you, Mum. See you another time.
Bye, Pedro.
If you found this podcast helpful, we'd love it if you could rate, review and subscribe. By doing so, you are spreading the word to help someone else just like you. Lynn would like to remind you that this podcast is general advice only, and you should always get legal advice in relation to your particular situation. And remember that the Australian laws may have changed since recording.